everyone. Come with me tonight. We're going to talk about the 1031 exchange with Russell Marsan. This is Living Room Sessions. Let's go. Russell is going to chat tonight about the 1031 exchange, so I'm super excited. Anybody needs any more wine or food, let me know. And with that, Russell,
cool.
Let's learn some stuff.
Thank you much. No, please hold your thunderous round of applause. It's all good. Well, good evening, everybody. Come on, we're small but mighty. We can do better than that. Good evening. Good evening. Much better, much better. Feel free anytime during my little chat here, because this is intimate, so it's just kind of back and forth. It's all good. Feel free to get up, get yourself some more wine, food, things like that. The more wine you drink, the more intelligent I will sound. And I also start to look a little younger too, so very cool. So drink up. So I'm Russell Marsan, Senior Vice President with Investment Property Exchange Services. We're the largest qualified intermediary in the nation. That's all we do is facilitate 1031. I've been doing it for 28 years, so I am your local go-to resource for 1031. We're not together very long tonight, like an hour. Let me be very clear. You don't need to remember anything I say tonight. What is the one thing you need to remember? Close. My phone number, yes. And it's on this brochure that you have here. That's my little QR code there too, so you can just take a picture of it and it'll download my contacts into your contacts, and you can call anytime. That's my cell phone number on it. You can call anytime. If you call me at like 9 o'clock on a Friday night, the first thing you don't have to say is, Russell, I'm so sorry for bugging you at 9 o'clock on a Friday night. You're not bugging me. As you'll find out tonight, I'm a tax nerd. So by default, I don't have a life. You'll be giving me a life by simply calling me and asking me tax questions. Very cool. My Friday night is like a big bucket of popcorn, right? And my bucket of popcorn's there. I've got my phone next to it. I'm eating popcorn, waiting for your call. Very cool. So since it is an intimate, small crowd, at any time, stop me and ask questions. You can take me off in any directions you want. Is there anything, because of our short time period together, and you knew you were going to be hearing about 1031s tonight, is there anything you came here tonight wanting to make sure that I covered? Like a question you want to make sure that I answered? Financing. Oh, okay. Yeah. Ooh, great question. I wasn't going to cover that today, but I will. That's a great question. Yes, yes. Yeah. Mm-hmm. Sisters. Right. Okay. Cool.
We don't want to do it all.
So you want to go your separate ways, yeah. Right, in a partnership. So how do you do that? Also, wasn't going to cover that tonight, but I will. So fantastic, excellent. We're throwing everything out the window tonight. It's all good. Gotcha. So let's answer that right now. These will come into play a little later. A trust is not a pain. A trust has nothing to do with taxation. A trust, everybody that owns any kind of asset should have a trust because it avoids probate. Right? But that's the only thing a trust does is avoids probate. So while you're alive, your trust is what's called a revocable living trust, right? And so it's not a tax. In our world, we call it a disregarded entity, which means it doesn't pay tax. It's the trustee within it that pays the tax. So you can sell as a trust and buy as an individual in a 1031 exchange, or vice versa. The trust doesn't matter. Now, where a trust does matter is if I pass away, right? And now I've decided I don't want my kids to have control of my assets because they're irresponsible. If you knew my kids, you'd totally agree with this. So I want to be in control after I pass on. So I want the trust to go on and still own the assets, and then they'll be the trustees. Well, once I pass away, if my trust continues to exist, it becomes a tax-paying entity. It's no longer disregarded. It has a tax ID number. It pays taxes every year. It files a return. And in that case, that's called an irrevocable trust. If it's an irrevocable trust, if you sell as that, you have to buy as that. You can't buy as an individual. Cool. Any other questions you want to make sure I address? No? Okay.
Well, one other, just when people think of like properties, so it doesn't necessarily mean that it needs to be the same type of property. It could be land and you could exchange for like a commercial property, or, right?
Definitely going to cover that,
okay.
For sure. That's one I was actually planning on covering, that one. But let's back up. Let's first just talk about the exchange itself. Right, the 1031 is actually the greatest wealth building tool in the entire Internal Revenue, right? Because it allows a real estate investor to buy and sell real estate throughout the course of their entire life without having to pay any tax, right? Because as we grow in life, our financial objectives, we're young, we don't have much money, we're trying to build wealth. So appreciation is our objective. Later on in life, we have a bunch of assets, a bunch of equity. Well, now we want to cash, or we want to go passive, right, in our real estate holdings. Those are different objectives. The 1031 allows you to pivot to different types of real estate assets to better meet your current financial objectives without having to pay tax. Right? So that's why it's the greatest wealth building. But some people And if you're an agent or work with clients, then you should always ask the client, hey, are you going to do a 1031 exchange on this property if it's not a primary residence? And a lot of times they'll say something like this. No, I'm not going to pay. I'm not going to do an exchange because I've calculated the tax in my own mind, and it's not that much. But there's two big red flags in that statement. What is one? What? That? Not that much. That's a big red flag. You're selling a California property. It's that much. We are the heaviest tax state in the country by far. But the other one is I calculated the tax in my own mind. I work with a lot of clients that have owned real estate for 20 and 30 years, and they're just selling their first property. They buy in whole. Right? If you haven't sold real estate in 20 years, you're not familiar with taxation. Because a lot of people think, I'm just going to pay 15% because they've heard capital gains. It is physically impossible to pay 15% when you sell an investment property anywhere in the United States, even if you live in a state that doesn't have state tax, which California ain't one of those states, right? The average tax in California when you sell a property is around 35%, can be in excess of 40%. Here's the various levels of taxation and kind of how that works, just so you can visualize it. So if I sell a piece of real estate, the first level of taxation is called capital gain. Right? So when I buy a property for $400,000, I sell it for $600,000, it's appreciated by $200,000. That's gain, that's profit. That's taxed as capital gain. The feds give investors an incentive to buy and hold investment stocks, real estate, things like that. So if you own a piece of real estate for more than a year and you sell it, then the federal government is going to say, okay, we're going to give you a little bit of a break. We're not going to tax you at your ordinary income tax level. We're going to bring you down to the long-term capital gains tax bracket of 15 to 20%. Whether you pay 15 or 20% depends on adjusted gross income of the actual exchanger, the seller, the taxpayer, right? So the state wants some of that tax also. The state doesn't have a capital gains. It's just ordinary income tax to this. So in the highest tax bracket in California is 13.3%. So let's say it's 10%. So between the feds and the state, you're looking at 25 to 30% in capital gain, right? And that's just based on the appreciation of an asset. And by the way, a little collateral damage from this, because some people will say, well, or they're like an elderly client, they're on a fixed income, and they say, well, on our fixed income every year, we're not subject to capital gains, right? If you look at the capital gains calculator chart the government has, it shows my tax bracket's the lowest, so I don't have to pay capital gains tax. Yeah, that's if you sold one stock for $100, right? You wouldn't. But when you sell a piece of real estate, you have gain. And if you've owned it a long time, you have $200,000, $300,000, $400,000, $500,000 of gain in that property. So when you sell it in that year, the gain from that asset becomes part of your income, your total adjusted gross income. So yeah, you made $40,000 a year for the last 10 years, so you're in that low tax bracket, but this year, guess how much you made? $540,000. So now all of your taxes, including the ordinary income, $40,000, is going to be taxed at a higher rate, right? So you get collateral damage from also, having this, paying the capital gain. But so that's just appreciation. There's also another tax. It's called depreciation recapture, right? Depreciation is one of the major benefits in owning real estate. If I buy a rental house or a commercial building, I get to take the value of the structures and depreciate them. If it's a residential property like a rental, the value of the house, which is on average going to be maybe like 75% of the sales price that I bought it for, that's a big number. I get to divide that by 27 and a half years. If it's commercial, 39 years. So let's say I buy a property in Napa and my 127th is $20,000 a year. So that's $20,000 of depreciation I get to take, which is an automatic write-off against the income, which is cool, right? The first $20,000 of rent, I don't have to pay taxes because I got this big write-off of depreciation again. That's great. But every year I take the depreciation, I'm lowering my cost basis in that property by that amount. So if I've owned that property for 10 years, I've actually taken $200,000 of depreciation. I've lowered my basis. So if I bought it for $800,000, after 10 years, that's not my basis. My basis is $600,000, right? So it went up in value. It went up to $1 million. That's gain. The depreciation is also taxed, but it's taxed at a much more punitive rate. That's 25% to the feds. Flat rate no matter what your income is. And the state, they don't care if it's depreciation or appreciation, it's all taxable as income. So that's the minimum of 10 to 13% to the state, right? So then you're looking at a minimum of 35% in tax on depreciation recapture. There's one final tax, and that is what we call the net investment income tax. It's really more commonly known as the affordable health care. And that's 3.8% on top of all that. That's a federal tax. So when you blend all those together, yeah, it's impossible to pay 15. More commonly, it's going to be 35%, could be over 40%. So the bottom line is you just want to make sure if you or someone you know is selling a property and it's not their primary, have they talked to their CPA? Do they know how much your tax hit's going to be? You want to make sure before you close what that tax hit is, because you don't want to be surprised. So if I think it's 15% and I close today, next year, a year from now, April 15th of next year is when I file my taxes for this year. And that's when I get the bad news. Wasn't 15%, it's 35%. And that's an ouch. And it's too late, I can't do anything. Right? Even with that knowledge of how much tax you pay in California, some people will still say, don't want to do an exchange. And that's because when you do an exchange, are you eliminating the tax? No. What are you doing? Postponing it, deferring the tax, right? Because it's transferring into my replacement property, all that tax. So I'm kind of kicking the can down the road. And CPAs will tell their clients this. I get this a lot from clients. They'll say something like, well, my CPA said, just pay the tax now, right? Because they think that capital gains tax is going to be going up in the future, which is possible. And why not just pay it now, since eventually you're going to have to pay it anyway? Does the client believe that? Of course they do, right? Because for two reasons. One is because it's their CPA. CPA is not going to be wrong. And the second thing is, everybody in this room, including myself, we've been patterned our entire life to believe that two things are absolutely inevitable. What are those two things? Death and taxes. You sang it like a choir, right? You all knew it. Yeah. Right. We've been lied to, right? Only one of those things is actually inevitable. Which one?
Death.
We haven't got that one figured out. But we do have the tax thing figured out. Okay, current estate tax law is incredibly favorable, right? If you're single and your estate is below $12.9 million, there's no estate. If you're married, double that amount. It's almost $26 million. No estate tax. And your heirs get a step up in basis. The step up in basis is the super cool part. So let's say I bought a property in Napa 60 years ago for 100 grand. And let's say when I pass away, it's worth $2 million, right? And let's say I pass away yesterday, which makes this presentation kind of awkward. I pass away yesterday. My kids go on title to the property today, right? Their basis in the property is not my old 100,000. It's stepped up to today's fair market value, $2 million. They can list and sell that property today. They don't need to do an exchange. They have a zero tax consequence from that sale. It's a tax-free sale because their basis is $2 million and they're selling for $2 million. There's no profit, there's no gain there, right? All the depreciation recapture, all the gain forgiven to the estate process. They don't have to buy other real estate. They can do anything they want, right? So that's why we say, don't cash out of real estate, or don't let your friends cash out of real estate. Instead, just recommend they exchange into something else that better suits whatever their current financial objectives are. Because I promise you, whatever their financial objectives are, there's some type of real estate that'll suit those objectives. So don't cash out. Instead, exchange until you, no, close, die. Thank you. Thank you. It was like wanting to say it. Yeah, we call it swap until you drop.
Yeah.
Very cool. Aw, it's so sweet. If somebody asks you, hey, what's the best way to avoid paying taxes? Tell them to what? Swap. No, die. Yeah, so die soon. Your kids will love you for it. Now death is fantastic. Run to the light. Your kids will love you. Yes. It's a great way. I'm just a tax guy, right? It's what we have nothing. So it's not emotional. Death is your goal. Death is the light. So any questions about taxes or estate or anything like that, estate tax law, before we're going to move past it. Cool. Now, again, what you brought, like kind. In a 1031 exchange, you can buy real estate and sell real estate. Well, first of all, show of hands, who here has never been involved in a 1031 exchange? Okay, keep your hands up. And who also has not been to a 1031 class before? Okay, pick on you. What's your name? Monica. Thank you for volunteering. Sure. So Monica, in a 1031 exchange, you can buy and sell them. But the two properties involved in that exchange, they have to be like kind with one another, okay? So let's say, Monica, you own 5 acres of land, nothing on it, just bare ground. And you'd like to sell those 5 acres, and you'd like to buy like this commercial building. Would you say those are like high five? Thank you, Monica, you're 100% wrong. Thank you for playing. Oh, you tried. Oh, I'll heart you. So I ask people that are not familiar with exchanges because the way you answer is total common. If I was not in the industry, I would answer exactly how you. This is it's misleading, this term like kind. Like kind is not about what a property looks, it's how it's treated. Any property that's treated as business or investment is like kind with any other kind of business or investment property. So raw land, you hold that for, even if it doesn't have income, you hold it for appreciation, which is investment, qualifies as like kind. So you can sell raw land and buy this commercial building. You can buy a rental house, industrial, commercial, mini storage, it's all interchangeable. All real estate's like kind with all real estate huge. Because if I own raw land, in this case, Monica's 5 acres. Does she have any income coming off that? No? Well, it depends on what she's growing. We don't know Monica. She brought the brownies. They're really good. Fantastic. Hook me up, I'm out. Also, she can't depreciate it because there's no improvements on it. So no income, no depreciation. It's a negative cash flow vehicle, right? You just pay your property taxes on it every year and you hope it goes up in value. You can exchange out of that. I mean, what's the land worth? I don't know, $500,000. It's $500,000 providing you with no income and no depreciation. You can sell that and do a 1031 and buy a rental house. Now you have cash flow. Now you have depreciation. Now you have a better appreciating asset in a lot of cases too. Do the entire thing free using the 1031. Right? But I count the number of times that tax advisors have told my clients can't exchange raw land for an improved property. It's not like kind. 100% false. Exactly, there you go. So I was first licensed in real estate, it's been 35 years ago. First class I ever went to was a 3-hour class on 1031 as a rookie agent. The instructor back then said, it's not like kind, you can't 1031. 100% false, right? So that's everywhere, right? But it's 100% false. So it's just good to know, right? Because if you have friends or yourself, you know, if you have friends or family or whatever that own land, hey, do an exchange, get into some income property, reposition those assets to better, you know, suit your investment objectives. But if it's all like kind, why even have that term like kind? Well, yeah, although like kind doesn't have to do with value, but you're right, you do have to buy for equal or greater value, that's correct. If you don't want to pay any tax, and I'll chat on that too. But so why it is like kind, we used to be able to do 1031 exchanges on things that were not. The Jobs Act changes it. Yeah, anything held for business or investment purposes, you could 1031 before 2000. So your boat, your jet airplane, your fleets of vehicles, your arts and collectibles, like your muscle car, your oil paintings, right? All of that was exchangeable. Livestock was exchangeable. No. And that's where the like kind comes in, right? And that's why there is this like kind terminology. Because in real estate, that's a very broad definition. In the other asset classes, it's very specific, right? I can't sell an airplane and buy a boat. It had to be an airplane for an airplane, a boat for a boat. Very specific. And that's what like kind, in fact, like for example, livestock. Here's a good example of how dramatic that is, the like kind. You can exchange horses. So I'm going to ask a question of the whole group. So let's say I want to sell both horses. I want to sell a stud and 1031 into a mare. How many think they're like kind? How many think they're not? How many didn't understand? Okay, I was going to say, how many didn't understand if everybody's one or the other? They are actually not like, believe it, the stats house, but I thought they were like, because horse for horse. But my mom finally gave me the talk. It was like 5 years ago. I'm like, Mom, why didn't you tell me this information before? This is good info. So no, it turns out they have the male and the female have different use. So yeah, not like kind. So it's that specific. Now, because of the Jobs Act, you can't 1031 anything except real estate. It's just real estate so as of 2007. So nothing's changed in the real estate world, just personal property. But now that's a really broad definition. But there are types of real estate that are not like, that you can't 1031. Anybody want to guess one type of real estate you cannot 1031? A houseboat? Oh, so yeah, actually, you bring up, that's a unique comment, right? So a houseboat typically isn't real estate, but in some states, it is taxed as real estate if it's primary residence and anchored to a boat slip or whatever. So that kind of falls back on state law, whether or not that's exchangeable. It's really, if it's a business use property, if you rent it out and it is considered real estate, then it is exchangeable. But in most cases, it's not exchangeable.
So that would be a mobile home that you couldn't, right?
So same thing, right? Mobile home, very similar, except one's on the water and super cool, and one's not so cool. So the mobile home is exchangeable if it's considered real property, which typically means it's affixed on a permanent foundation to the real estate and it's taxed as real property. If it's not, like if it's in a mobile home park,
then you couldn't.
It's personal property. And it's also taxed as personal property, right?
Yeah.
And that wouldn't be exchanged.
Okay.
You do, not real estate, not real estate. Yeah, you have that's personal property tax. Yep. And the same thing with a mobile home would be the same way if it's not real estate. So there's real property and personal property. You're taxed as personal property. Only real property qualifies 1031. So one type of real estate that doesn't qualify 1031 is inventory property. Inventory property, if your intent while you own a piece of real estate is to resell that property, doesn't qualify 1031. So who would be an example of somebody who, a flipper, exactly right. All spec home builders, those are the two examples. So a builder, they buy land, they subdivide it, they build spec homes, they sell it. Flippers buy, fix up, and sell. Right, their intent, no matter how long it takes them, their intent is to resell the property. They don't get 1031. They're considered dealers in the IRS's eye, right? And you have to be an investor, not a dealer, to qualify for 1031 deferral. So if you have, and in fact, they don't even get capital gains treatment. Like if they own that property for more than a year as a builder and they sell it, they don't get the benefit of capital gain. They pay ordinary income tax rates on that because it's what they do, right? It's inventory property. It's no different than a person that owns a store. They buy a can of beans wholesale, they sell it retail, right? That's inventory, ordinary income. So flippers, since you brought up flippers, if you or anybody you know is a flipper and they ask you, hey, I heard about this 1031 thing. Should we be thinking 1031s on our flips? There's really only one question you have to ask them in return, and that is this. Mr. and Mrs. Flipper, do you need the money from your flips to live on? That's the only question you have to ask. If they say, well, yeah, that's how we pay our bills, fine. You keep flipping to your heart's content. You're going to pay ordinary income tax on the income just like the rest of us do, and don't even think 1031. But some flippers will say, no, we don't need the money, right? We do something else for a living. They're a fireman, they're a teacher, they do something else. They just want to flip that equity into the next property, right? 100% of the proceeds. Ooh, okay. Well, then they need to start thinking 1031, but they need to alter their strategy. So instead of buying, fixing up and selling, they should buy fix up and what? Rent, exactly right. Establish that held for intent, right? Because a flipper is never gonna rent a property. A builder's never gonna rent their spec home. Once you cross the line of putting a tenant in there, you've crossed the line from being a dealer to an investor in the IRS's eye. So yeah, buy it, fix it up, rent it out, and then you can what? No, you can't yet. You have to fix it up again. You had tenants in it. Hello. So buy it, fix it up, rent it out, fix it up again, and now I get to sell it and do a 1031. Yes. Ooh, good question. What do you guys think? How long do you think you have to hold it for? 2? Okay, anybody else want to guess?
I would say 2.
3, 2, 1. You're all correct. There is no stated time period.
Oh.
The IRS has never created a revenue procedure that says this is how long you have to hold a property before you can sell it and do a 1031 exchange. They never have, and let me be very clear, they never will. They will never create that revenue because the IRS doesn't care about time, they only care about your intent. I follow case law in the industry. I read case law every night before I go to bed. Very cool. I warned you, I have no life. I can show you case law where clients have held properties for as short as 3 months, sold it for a huge profit, did a 1031 exchange. Federal tax court said, yep, that's perfectly fine. I can show you other case law where they held for 5 years. That exchange was disallowed. So 3 months was fine. 5 years was not okay. That tells you right there. It's not about time. It's about intent. So just so you kind of better understand this, the case law, very fascinating. This is one of the most fascinating case laws in all of 1031 lore, this 3-month case law. So I forget the guy's name. We'll call him Bob. Bob bought a property on the border of a residential area, right in the neighborhood. He wanted to locate his business inside of the structure. The zoning laws were perfectly legal and fine for his type of, but the neighbors that lived like right around that structure, they didn't want that business anywhere near their home. Anybody want to guess what that business was? What do you think? Cannabis? No, they totally want cannabis. They have kids and they're stressed. they need weed. Strip. Wow, you went right to that. You're like, strip club. Very cool. What's that? A sex shop. Wow. Well, tell us how you really feel.
Even better.
Don't sugarcoat it. A sex shop. I don't even know what that is. What is a sex shop? A bar? No, they want a bar. They want alcohol and weed. They totally would be fine with that. A mechanic? No, it wasn't a mechanic shop. You're actually the closest with the sex shop. I forget. Yeah, it was like Bob's Palace of Pornography, right? Yeah, you went nice. You were thinking something else, but you said, like, I don't know you guys well enough. So what happened was the neighborhood didn't want that, right? So the neighborhood got together and formulated the plan. And so then the neighborhood, they went to Bob and they said, Bob, hey, you bought for X amount of dollars 3 months ago. We are willing to buy you out of town for 200% of what you just paid for the property. 200% profit in 3 months. He's like, oh yeah. In fact, I'm pretty sure he was thinking, I have a new business model, right? I'm gonna buy, I'll buy property, scare the hell out of the neighbors, force them to buy me out, make a big profit, and never have to open his porn shop. So in fact, by the way, that'd be a killer reality show, like flipping porn. I'm gonna trademark that. You guys can't take it. or a flipping sex shop, whatever you so he did an exchange, right? And the IRS said no to him because on paper, what did he look like? A flipper. Total flipper.
Yeah.
He bought 3 months later, sold for a big profit, never actually opened a shop, right? He fought the IRS. He went to appeals court, and appeals court agreed with Bob because of 3 things. He never held the property for sale, wasn't listed. He was approached unsolicited. Neighbors came to him, he didn't do it. And he proved to the court, hey, I was planning, here's my plans. I was planning on opening a shop, right? He had a long-term business plan. So he had a valid exchange that was upheld in court. Now the person held for 5 years and they were disallowed. As soon as they bought it, they put it right back up for sale. They held that property for sale the entire 5 years. Never took it off the market. Okay.